Welcome. Welcome, everyone. It's Angelo Robles. If you're live, it is Tuesday. To be rather exact, or close to exact, it's 4 p.m. Eastern. There's always a value to being live. One, you can interact with me and our guests. That's the main value. And who knows? Maybe we're going to say such cutting edge things. Maybe the platforms, poop, they cancel it, or something goes wrong in technology. So you always want to be live and get the information at the moment. I'm the founder of that family office, and as many of you know, my members of SFO Continuity, a longtime veteran, not to say that I'm that old in the family office world, and I love to do interviews on things that I think are important, forget about me, but to my audience. So we have a special guest today that about 6 years ago, I might be a little off on that, was a guest, and I don't know what's going on now in Iran, in energy, in the US, in electricity. He might be the perfect guest. So I think no matter who you are, but especially an allocator, you're in for a treat. I'm calling it, although it's a limiting title, so pardon me, AI runs on electricity. Electricity runs on reality. Now, to give you a little bit of context, deregulation began in the 1980s and 90s. It created kind of a hybrid system, having competitive markets for electrical power, really honestly, in probably 15 states, representing 42% of power demand, and a vertically integrated cost plus revenue model for power generation in the other 35 states, representing 58% of power demand. So there's a lot that many of you, as simply understanding AI and energy, but not quite getting the electricity part, or looking to hedge risk or make money as an allocator or a family office. I meet with multi-billion-dollar families, and I think a lot of them get really confused by this. So we have a guest. He's in my backyard, at least sometimes, in Greater Connecticut, and that would be the return of Jim Murchie. He's the co-founder, co-portfolio manager, and the boss, the CEO of Energy Income Partners. Jim, welcome back to the show.
Thanks, Angelo. Yeah, I didn't realize it was 6 or 7 years ago. Boy,
time goes by, but we age fine, Jim, and we get, I hope, even better. So hopefully we'll even trounce what we did a couple of years back. And audience, unlike what you're used to from me, we're going to try some different formats. We're actually going to only ask Jim about 6 or 7 questions, but go very deep into them and really allow Jim a chance to, not that I interrupt my guest, but give him a chance to really have an opportunity to go deeper in somewhat of a more condensed interview. Many of you have a busy schedule, but absolutely not condensed on the knowledge coming at you and things that are going to be valuable to you as really anyone, but definitely an allocator, investor, and family office. So Jim, let's get right to it. For 20 years, America kind of treated kind of what a flat electricity demand as normal. Was that stability real efficiency, or was it a visible symptom kind of deindustrialization, offshoring, and really underinvestment?
Yeah, so the underinvestment was a reaction to the lack of demand growth. And, and it's hard to actually measure this. We've tried. There's probably some people in the DOE that have a really elaborate model, but I roughly think of it as half and half of the two factors that you mentioned. So to give you an idea, though, so your investors probably old enough to remember the two oil crises in 1973, 74, 1979, 80, and that triggered tremendous changes in energy efficiency of everything that used energy, from cars. The average mileage of a car rolling off an assembly line doubled over about 6 or 7 years. And that was true of everything that uses electricity. Like the biggest efficiency you see is like in refrigerators and freezers. The ones in the sort of the late 1980s, early 90s were 70, 80% more efficient than the ones in the 1970s. And so as that worked its way through the system, as a high efficient air conditioner, refrigerator, electric motor replaces a less efficient one, that chews into demand growth, which of course would increase with economic activity and the building of houses and households and things like that. And the other was that industrial production in the United States went sideways for 20 years. And so when we look at electricity demand for the industrial sector, we see it goes down. And so those two things tell you that they're both a factor, because the amount of widgets we were making was going sideways for 20 years, but the electricity needed to make those widgets went actually down. So that's why we know it's both. Think of LED light bulbs, right? So LED and compact fluorescence are 70-80% of all the lighting that's out there today, and LED is 80 to 85% more efficient than an incandescent light bulb. So, but that's in the rearview mirror. So both have been affected, and of course the offshoring has slowed. We are reshoring, and that's why electricity demand has gone from essentially zero for the last 20 years to about 1.5% a year for the last, call it, 3 or 4 years. And the big data centers are still under construction.
And what does that exactly mean? So obviously they're not completed. When they are completed, and new ones are going to be built, I think, all the time.
They're under construction. Yeah, I think that takes you 1.5 to 2.5%. So when you look at the forecasts for electricity demand growth, you get to 2.5% from the people who tend to do it top down. And when you ask the individual utilities state by state what they're seeing and what they're filing in terms of their long-term plans with their public utility commissions, that number gets to about 2.5%.
Explain the difference between regulated and competitive power markets, kind of in plain English. Who takes the risk? Who owns the return? And who gets punished when, well, pardon the pun, the lights go out?
Yeah. So yeah, your intro was very good. The world, the OECD went through a big deregulatory phase it started in the late 1970s and continued in the 80s and 90s because some businesses took a very long time to deregulate. In the United States, it actually started under the Carter administration. Deregulation was actually a progressive political agenda item. Reagan was very smart in terms of adopting it for himself. But the three big deregulation industries that were deregulated in the United States were energy, transportation, and telecommunications. That was the time when we broke up Ma Bell into 6 regional Bell operating companies. The government actually sued to break up AT&T. It's when we deregulated the airlines, and a gentleman by the name of Alfred Kahn, who most people may know as Carter's inflation czar, actually started off engineering and overseeing the deregulation of transportation, and then his responsibilities spread. So when we look at the pressure for deregulation in electric power in particular, it was driven by massive cost overruns in nuclear power plants in the 1970s. And when I say massive, I'm talking 3 or 4 or 5 times the original budget. There was one power plant that ultimately was finished at 10 times its original budget. And those budgets were twice as high as plants were being built in the 60s. So it was a tremendous increase. And back then, all electric utilities were regulated at the state, and they still are, and they were all vertically integrated. They were all monopolies, and a monopoly operates on a cost plus revenue model. So these monopolies go all the way back to the late 19th century. It's the 20th century. Okay. So, late 19th century. So Thomas Edison and his right-hand man sort of had the idea that a natural monopoly should be a legal monopoly. Railroads in the 1800s were a natural monopoly, but not a legal monopoly, and they were a horribly, cyclical boom bust business, which resulted in all kinds of safety issues, financial distress, financial shenanigans, a massive consolidation by the people who held the debt. These are names that people are familiar with: J.P. Morgan, Cornelius Vanderbilt, Jay Gould, E.H. Harriman, Averell Harriman's father, Brown Brothers Harriman, and that triggered the first federal regulatory agency in 1897, the Interstate Commerce Commission, to regulate railroads. And it also brought forth the Sherman Antitrust Act. And those two weren't enough to sort of discipline these monopolists. And so they passed two other laws, the Elkins Act and the Hepburn Act. And that gave the government the right to prevent any price discrimination amongst customers and actually set the price of railroads. So railroads were this Frankenstein's monster of a free market, natural monopoly and government constraint. And so Thomas Edison and his right-hand man, Sam Insull, had an idea of, look, just make it a legal monopoly. Just grant a monopoly to a certain geography and get back from that company two very important things in return. An obligation to serve. That means safe and reliable service. You say, why do you have an obligation to serve? Well, they're a monopoly. The customer doesn't have a choice. You can't say no to the customer. They don't have a competitive choice. What's the second thing? Limits on what they can earn on their investment. They've been granted a monopoly. They could otherwise charge what they want. Well, how do you do that? Cost plus revenue model. So the company collects from customers an allowed revenue, which is the sum of their operating and capital costs. So a utility adds its operating cost, its interest on debt, and an allowed return on equity. And that's its, if you will, its operating and financing cost. And since that's its cost, that's its revenue. And that includes a return on capital for the investors. And so that is the model that was in place for 80 years, 90 years. And so when the nuclear power plant cost overruns happened in a cost plus system, everybody's bills went up. Well, if you're a homeowner, you don't have any choice to do anything about it. But if you're a very large industry, you have a choice. You can actually make the electricity yourself. So when I started my career at the old Standard Oil Company of Ohio in 1982, when I ran business development for refining and marketing in the middle 1980s, my team was running economics on making our own power. We could do it for 3 cents a kilowatt hour. The grid was charging us 6 cents a kilowatt hour, and we were the largest customers with our giant refineries in the state of Ohio. And so we were going to cut the cord. Well, we weren't the only ones. So that means fixed costs, which back then were probably 60% of costs for homeowners. Today it's 80. Those fixed costs would be divided amongst fewer kilowatt hours, right? Because in a cost plus system, you add up your cost, you divide by the kilowatt hours, and that's how you charge people. So industry has a different rate than commercial and residential because their usage per unit of capital is much higher. But nonetheless, it's total cost divided by kilowatt hours. That's what you pay. And what happened, was, deregulation. The federal government said, you guys at the states are screwing this up. We can't tell you what to do. You have the right to regulate these businesses. But as the federal government, we can create wholesale competitive markets that anyone can sell into. Now, if I'm going to do that, I have to create laws that allow that independent power producer to access the poles and the wires, which are owned by regulated monopolies, regulated at the state level. Yes, interstate wires are under the jurisdiction of the federal government, but those wires make up less than 10% of the investment base of the entire system in the United States. So yes, the federal government has an influence, but all this stuff is mostly regulated at the states. And so creating those competitive markets took over a decade.
Wow.
And so by the time you got to the early 1990s, it was in place. Now the states are deciding whether or not they want their legacy vertically integrated utilities to separate generation into those competitive markets from the poles and the wires, which is a cost plus system everywhere today, not just the United States, but in basically every country in the world, because it is a monopoly. But power generation can be competitive so long as there's free and open access to those wires. So 15 states, which today represent 42% of electricity demand, decided to tell those vertically integrated utilities, your life has fundamentally changed. You're going to spin that out into a separate business. It's no longer cost plus. You will make money on the difference between your revenue and costs. And if you can't keep your costs down, well, then that's your incentive to keep costs down. And the other 35 states knew their history, knew what a disaster cyclical businesses in a monopoly can be, like the railroads. And they said, we're not in for that. We want stable prices. We want reliable service. And, we view it as a public good, like infrastructure and literacy and national defense. The irony is that 80% of those socialist system states are red and 80% of the free market states are blue. So it doesn't fit, the neat political narrative by a long stretch. In fact, it's the opposite. And so when people see electricity prices at the wholesale level going up, now that demand is growing again, I don't know why it's a surprise that in those 15 deregulated states, the price is going up. I mean, if you ask the fifth grader, if all of a sudden, widgets are in more demand this year than last, and demand grows faster than supply, what do you think is going to happen to the price of widgets? I bet you 80% of fifth graders would tell you it would go up, even though they haven't had an economics class. But what's confusing to the public is that this distinction between that system, the competitive system, and the cost plus system has not shown up in a single newspaper article or a single news show or any podcast that doesn't include, someone from my firm. This is obviously very well understood in the electricity industry, but it's not actually understood in the broader energy industry, and people are simply unaware of it everywhere else. And so when you look at the wholesale price progression in the last 3 years in the cost plus states, you see that it's actually gone sideways for wholesale prices, for the really big industrial customers. The last 3 years, prices essentially have been flat. And in the deregulated states, it's up about 35%. Shouldn't be a surprise, because in a competitive market, prices are set by supply and demand. And if those prices don't reward the highest cost producer, well, then there isn't enough electricity to go around. But in a cost plus system, since so much of those costs are fixed, now that demand is going up, it actually puts downward pressure, all else equal, on those prices. And so what you're finding is that it's taken a while, but you've now had 2 utilities explain this to the greater public. I mean, 2 out of like 80. I mean, this is not catching on. And so in November, AES Corporation, which has a cost plus utility in Indiana, put a slide in their investor deck showing 4 different scenarios for data centers coming into their state. And there were 4 lines. The first one was kind of horizontal and rising. That's no data centers. And scenario 1, 2, and 3. And the more data centers you got, the more residential prices went down, because the denominator is getting bigger. Think about it. It's the exact opposite of what happened in the 70s when we had the cost overruns for the nuclear power plants. The reason we had to deregulate was that large customers would leave the grid and make prices higher for everyone else, because those fixed costs would be divided by fewer and fewer kilowatt hours. The opposite is now happening in vertically integrated states. So then the other company is Southern Company. And they said, a month ago, 6 weeks ago, they said, look, for every gigawatt of incremental demand here in Georgia, customer bills over the 15-year life, if we say it's only 15 years, of that data center will go down by $1 billion. And that's the arithmetic of dividing those fixed costs by more kilowatt hours. 2 entirely different systems, 2 entirely different outcomes. Now people say, well, okay, then you must think the cost plus system is the better system. Hardly. It's the cost plus system that failed in the 1970s and 80s. We had the massive cost overruns, and that's why we got deregulation. But the world is now experiencing, commerce on a global scale, where you've consolidated the number of suppliers for even critical things like logic chips. There's 3 companies in the world that make logic chips. There are now also 3 companies in the world that make baseload natural gas fire generation: Mitsubishi, Siemens, and GE. 3 on a planet of 8 billion people. That's the efficiency of the capital markets. But the capital markets are not responsible for reliability. Governments are. And so it is no more the obligation of an independent power producer to be a reliable supplier, although there'd be political pushback, but legally and technically, than there is for an aluminum or copper producer to be a reliable supplier to the London Metal Exchange. It's just not how it works. And why would it work that way? He said, well, electricity is different. Well, that's what the 35 states thought, and that's why they're doing it that way. So now that you're in an upcycle of demand versus supply, of course, the cost plus model looks better. But the fact that we have both, and I know it's confusing, and I know it sounds like a mess, but it actually works the best because they compete with each other. And you say, well, now how do you mean that, people can't move their house to save electricity? No, but data centers can choose which states they go to. And in the deregulated states, really, except for Ohio, Pennsylvania, and Texas, you're not really seeing a lot of activity from the data centers. They want to be a customer of the utility. Are they doing their own generation? Yes. Why? Because it serves their need of getting to market quickly. But they don't want to be in the electricity business. They like the stability of the grid. They like someone else running it. And you know what? When you're in a vertically integrated state, the company who's making the generation also owns the wires, and the company that owns the wires on an intrastate basis, so long as a project is approved, which of course they can't be built without approved by the Public Utility Commission, they have the right of eminent domain to run those wires. So it's one-stop shopping for the data center. And they know, because I know the energy heads of the big tech companies, I see them at the Aspen Institute twice a year, the Energy Roundtable. These are some of the most sophisticated, if not the most sophisticated electricity buyers in the United States. All of this market structure stuff that I just explained, they could do in their sleep. They know it better than I do. And so they know that if they absorb some of the existing overheads in their tariff when they come into Louisiana or they come into Indiana, they know that all else equal, that will lower residential rates and reduce the political pushback against them coming into their state. But the narrative that's out there is data centers are going to push up prices. Well, anyone that increases demand faster than supply in one of those 15 states is going to push up prices. That's how it works. That's how it works for oil and gas. That's how it works for copper and aluminum. This shouldn't be a surprise to anybody. But the vertically integrated states and the utilities in them need to do a better job of explaining why that system in those states is different.
Jim, that was like a masterclass that even the most sophisticated family offices understanding energy output and electricity, I think, got tremendous value on. And see, you guys tell me that I interrupt guests too much. Sometimes you gotta know just to let them run. That was incredible. And by the way, I hope you're all enjoying. Jim really is a national treasure. He may be the most knowledgeable and successful person in this industry. Does not appear on many programs. We're very fortunate to, for a ballpark 50 to 60 minutes, have his time. Yes, it's a little technical, a little niche-y, but if you want to get that edge in today's market, I think these are the kind of people that you need to listen to. So I think you went over very detailed, kind of the two side-by-side systems, competitive, cost plus, how the industry is addressing the need for more power, the variance among the states and some that you noted, and to some degree, the investment risk that will lead effectively to higher or lower electrical prices. Why don't we move a little bit to how does this demand profile affect how the industry will respond? And are investors fully understanding that?
Yeah, so when you look at, we have a lot of data in this world of ours today, and in the energy industry, they report all their data to the Department of Energy. So the Department of Energy has what's called the A60 report. The A60 report is, it's a spreadsheet. They don't download it into your Excel, right? And it goes back to the 1930s. And it has every plant that was ever built of any utility scale and when it closed. And all the existing plants, of course, are on there. And when they are planned to be closed by their owners who report all this data, right? So when we look at the 5-year plan for forward capacity increases, and we looked at this report, say 3 years ago, just as the electricity demand thing was becoming apparent, what we saw was 170 gigawatts of wind and solar to be built over the ensuing 5 years, closing 50 gigawatts of coal, building 20 gigawatts of natural gas fired generation, and everything else, nuclear, geothermal, hydro, next to zero. Those numbers today, 3 years later, same 170 gigawatts for wind and solar, same 50 gigawatts of coal being planned to be shut, but now 75 gigawatts of natural gas. So a 375% increase. And nuclear and everything else, maybe you get to 5 gigawatts. So again, in a 5-year time frame, everyone knows nuclear power plants take a long time to build. So regardless of what you think of nuclear, in the next 5 years, it's hard to be a material number. So it's mostly natural gas. And you say, well, okay, from an investor standpoint, who's building those natural gas? Well, there's two types of natural gas power generation. One is base load. Now, the industries are all great at confusing people, and they call a base load unit a combined cycle gas turbine. And what that really means is it's a two-stage process. There's actually two turbines involved. The first one looks like a jet engine. I mean, it is a jet engine. And you put natural gas in it, and the thing spins just like a jet engine, and it helps spin that axle, which turns those magnets, generates electricity. But the exhaust of that jet is still hot, right? No one would stand behind, the wing of a jet aircraft. It'd burn you to pieces. It's enough energy to turn water into steam. So in the first stage, you capture 35%, 36% of the energy of the natural gas. But the exhaust is so hot, you convert water to steam, and you run that through a steam turbine, which have been around over 100 years, right? And so that gets the capture of the energy inside that natural gas from 36 to 65%. That's a base load unit. It's meant to run pretty much all the time, and it can ramp up and down. So the world today makes about 100 gigawatts of natural gas fired generation coming off factory floors. A little less than half of that is that base load. The other half is just a single stage turbine or a reciprocating engine made by Caterpillar or Cummins or Wärtsilä out of Finland. And those, of course, have that 37% efficiency. So when you hear about data centers doing behind the meter, and they're doing this mostly in deregulated states, and so far you've heard about projects in Pennsylvania, Ohio, and Texas for the most part, they're using those single stage turbines. And in some cases, in the XAI data center in, I think it's Louisiana, they're reciprocating engines. Like a truck engine. It's much bigger than a truck engine. It's the size of a house, but it's a piston engine. And so inside the deregulated markets, the independent power producers that operate baseload power, and we have 4 of them that are publicly traded, but there's a lot of private ownership of these things. They're not building baseload, with one exception, in one particular project. The base load is going to the vertically integrated states. Now, I've had so many people say, well, this is kind of funny, actually. They say, well, you can't get any base load power because the backlog is 6 years. And it's like, well, you can't because you just made the phone call yesterday. But the reason you can't get it is because they're cranking these things out as fast as they can. And so it's like the Yogi Berra thing, when he said, well, no one goes to that restaurant anymore. It's too crowded. So it's like, no, people are getting, new generators. It's just that if you're not in the queue, you're not going to get one for 5 or 6 years. And so the shareholders of the independent power producers are telling these guys, look, if you don't have a long-term contract, I don't want you building one of these things because this thing may last 5, 6, 7 years, and this is a 30-year asset. I want you to just buy back stock instead. But the shareholders of the vertically integrated utilities are incentivized a different way because it's cost plus. And you say, well, what does that have to do with an investor? Well, think about it. Your operating costs and your interest on debt are a pass-through. Your profit is an allowed return on equity. So there's 2 ways to grow your profit. You can buy back stock or grow the investment base upon which you earn that allowed rate of return. And so the shareholders of the vertically integrated utilities are like, well, this would be great if this opportunity allowed you to put more investment on the ground that is, of course, approved by the Public Utility Commission and is actually generation that's going to be used by someone And it would be nice if they made some kind of commitment to you about it, like 15 years at least. And that way my investment base would grow and my earnings would grow. Well, sure enough, when you look at the utility, the regulated utility sort of universe, going back 5 years, the average growth rate of earnings was 3 or 4%. Today it's 7 or 8. It's doubled in the last 3 years. Now, this growth is not economically dependent. It's not exposed to the economic cycle. It is a call. If in fact, if in fact, as an investor, you find that the data center is coming to the state that this vertically integrated utility is, and sort of like, for example, in Louisiana, Meta is building a big campus in the middle of nowhere, and they're signing a 15-year contract with Louisiana vertically integrated utility. So why do they need a contract? It's a cost plus system. And you say, you're right, but Louisiana is doing this right. They're saying, Meta, we're not experts in AI or anything like that. And I know you're going to build this, and I know you're telling us you're going to use the power, but what if you come up with chips that are 10 times more efficient? You don't need the power. I'm not going to stick the residents of Louisiana with this cost. So you're going to basically have a fixed obligation, whether you take or pay, whether you use this electricity or not, for 15 years. And in fact, that Louisiana utility will say that all else equal, the customers' bills will go down about 15%, because the first phase of this Meta, to give you an idea of the scale, the first phase of the Meta deal, which is 2.25 gigawatts, ultimately be to 4.5. That 2.25 gigawatts represents 17% of existing Louisiana electricity demand from one AI data center. And that number is going to double over the life of that project, or the build out of that project over the next 5 or 6 years. So it's a huge number to the denominator. It's good for the residents of Louisiana. It's growing that utility's investment base by 12 or 13 or 14%. They will issue debt, which is a cost pass through. They will issue equity, which will have that normal dilutive effect. And so their growth rate is 10% plus or minus a percentage point. And so that's just one example of how an investor looks at it, who's investing in a vertically integrated utility, and what their incentives are to put capital on the ground, versus the independent power producers, of which there's 4 publicly traded ones, where their shareholders are saying, unless you get a long-term contract, I don't want you putting that capital on the ground. So in fact, the build out in those states are these single stage turbines being bought by being bought from Caterpillar, Cummins, Wärtsilä, and a couple of other smaller players. And the independent power producers don't want those, because in fact, what those data centers have said is that we will use these generators that were meant for backup generators 24/7, but we're only going to do that for about 5 years, because by then there will be more baseload capacity on the grid, and we will shift from making our own power to being on the grid. That is a consistent message you've gotten from all of them. And so the duration of the return to that capital is much more at risk than in a vertically integrated state. It doesn't mean it's going to lose money, but the contract structure and the duration is simply less by virtue of that dynamic.
Jim, what is the role in this of intermittent wind and solar?
So they do generate electrons, but the demand of the data centers, it's not 24/7, 365. I mean, it is 365, but there are actually variables in their daily use of electricity. The trick is the fact that when they want to use it, the wind may not be blowing, and it also may be at night. And so that then brings in the issue of, well, do you just store it? And this is the other thing that, again, is so misunderstood. And I first learned about these economics from none other than the Clean Air Task Force. And they did a report to sort of warn their environmentalist friends that using batteries for seasonal storage is extremely expensive. So what do I mean by seasonal storage? Well, the demand for electricity in the summer in the United States for air conditioning load is 2 times the amount of electricity demand in the shoulder months of April and October when you're not really using air conditioning or heating. 2x. That's for the country as a whole. Think of some states that get really hot, in the summer, but they're still cold in the winter. So think of the states along the Mason-Dixon line, right? In those states, it's maybe 2.2, 2.3 to 1. And so you say, well, okay, let's build a battery to do that. And you say, well, okay, let's imagine, that we can get the cost of a battery fully installed and everything down to $100 a kilowatt hour of storage. Kilowatt hours is, what you see on your electricity bill, right? So the average electricity bill for a resident of the United States is 17 cents a kilowatt hour. You say, okay, so I'm going to get this device down to $100 a kilowatt hour, even though it's 250 today. But let's say it goes down to 100, and you're going to use that device once a year for the seasonal peak. You're going to charge it up in April, and it will discharge in July. And if you're below the Mason-Dixon line, where you have a second peak that's almost as high as the winter, because so much of the heating down there is heat pumps, there's 2 peaks, right? But let's say you're only going to use it once. You say, okay, I spent $100 for this device. Let's imagine the device has no operating costs. Let's imagine there's no such thing as income taxes. Let's imagine that this battery lasts literally forever, and that we can finance this with some instrument, some way, shape, or form for 5% a year. Okay, all fantasy, but let's just keep the math simple. That $100 device will therefore cost $5 a year. If I cycle that device once a year, that kilowatt hour costs me $5. If I cycle it twice, it costs me $2.50. If I put it next to a solar panel to back up the daily cycle of the sun rather than the seasonal cycle of the winter and summer, the cost goes down to 1.7 cents a kilowatt hour. That is battery economics. And I'm telling you, outside the world, inside world of electricity, no one, and I mean no one, knows those simple economics. They're not complicated, but nothing people read about describes that simple arithmetic. Any capital asset is cheaper the more you use it. And if there's one seasonal peak and you're going to use the battery for that, then the per use is expensive. And so there is a role for wind and solar. And what you see is the money shifting to solar, because solar and batteries is competitive. Wind and a seasonal battery is not. So the wind actually goes down in the summer when we need the extra electricity. Solar actually goes up in the summer when we need more. And so you see the dollars shifting towards solar. But those storage economics are fundamentally misunderstood by virtually everybody. And so there is a role for wind and solar, but they're already maxed out, because the gating factor, not only are they intermittent and we need power 24/7, the gating factor is the transmission it takes to hook these things up, because they tend to be in rural areas, right? These are big utility scale solar farms and wind farms. And so that's why that 170 gigawatts in the 5-year forward plan hasn't really changed much over the last 3, 5, 6, 7 years, and probably won't going forward. And nuclear takes a long time. Coal, no one's going to really build a new coal plant. You can argue about the rate at which they continue to close. There are emergency powers, by the way, at the federal level, the regional level, and the state level, to keep those plants open and compensate those owners to make sure they're covering their costs. So it's possible that closure of 50 will be smaller, but that's why the default of how am I going to get this power is natural gas. And it's split between those sort of backup units that you're going to run 24/7 and the baseload units, which GE, Siemens, and Mitsubishi are now manufacturing as fast as they possibly can.
You hinted at it a couple of times. Let's get right into it. What role can nuclear play, and what, if any, is the opportunity for investors?
Yeah, so nuclear, I think, has the best chance for a renaissance now than any time in the last, call it almost 50 years, when we peaked out, of building nuclear power plants, which came to an end because they were so cost uncompetitive, right? So when we look at nuclear and we say, well, why don't we build nuclear power plants? there are three shortcomings. The first is cost, and that's probably the most important one, because if you can't be competitive, the other shortcomings don't even get discussed because the plant doesn't get built. And the other two shortcomings are the risk of a meltdown, right? So we've had three visible ones: Chernobyl, 3 Mile Island, and Fukushima. Three, and then the third is, what do you do with the waste? So when you hear about all these nuclear technologies, they are designed to address those three shortcomings. So small modular reactors are a response to the cost overruns. So we have 94 operating nuclear power plants in the United States today, spread across roughly 51 sites. So a typical site has 2 reactors on it, and each one uses essentially the same technology. We're using, we're fissioning uranium. We've enriched that uranium to 3 or 4 or 5%. And what that means is you've concentrated the fissile isotope, which is uranium-235. That's the unstable isotope, versus uranium-238. Right. So in nature, only 0.7% of uranium is uranium-235. So enriching it is really concentrating it in a centrifuge. Through a 2-step process, you turn it to a gas, uranium hexafluoride. Now it's a gas, and you're spinning it. And the uranium-238 is heavier, so it goes to the outside, and the 235 is in the middle, and you pull it out. And you only need it concentrated to 3 or 5% to put it in what's known as a light water reactor. Conventional water is where the reaction takes place. It moderates the speed of the neutrons, and it takes the temperature away. That's the same technology everywhere, but each site is different. And so what happened at Fukushima was that the elevation from the ocean cooling water was higher than what GE designed in the 1950s. And this is right after the war, and GE's like, this is the design we make. And so they put the nuclear reactor closer to sea level than they wanted to, because they know they have tsunamis, and you saw what happened. And so it's all these local quirks that means each of these plants, when they're constructed, is slightly different. The only way to bring the cost down is to build the exact same thing over and over and over again. The French did that. They had 2 sizes. They did it over and over and over again, and that's why nuclear is almost 80% of France's capacity. A small modular reactor says, look, you may want 5 gigawatts. I'm not going to build you a 5 gigawatt plant. I'm going to build, say, a 100 gigawatt plant and give you 50 of them. Well, that's inefficient. Not, as history would tell you, as inefficient as building a unique plant of 5 gigawatts, because it's slightly, you haven't built that one before. That's what small modular reactors are meant to do. It's not that you're going to put those small modular reactors next to a data center. It's you are trying to get the manufacturing efficiencies and the what's known as Wright's law, the adoption curve of making the same widget over and over and over again that gets the cost down. The second one is the meltdown. So you can adjust this with how you encapsulate the fuel. You can do it by not having light water as the coolant. You can have liquid molten sodium, which does not have to be at pressure. So to control the reaction, the molecules of water control it, but the reaction is taking place at 330 degrees centigrade. At 330 degrees centigrade, water is a water, it's steam. And so you got to have this giant vessel that holds the water and compresses it so that it's steam. If the reactor runs away, not because the nuclear physicist got anything wrong, but because the damn valve broke or the pump broke or something that's 100-year-old technology, and now the thing is going to explode because it's under pressure. If you put a coolant and a moderator in there like molten sodium, it's not under pressure. And that's what that technology is for. So finally, you get to, what do I do with the waste? Well, you can process the waste we have today. It's just expensive. The other thing you can do is you can change the technology. And instead of slowing the neutrons down, which you do so that when they land on that only 3 to 5% of the uranium, that's uranium-235, it doesn't glance off like a billiard ball. It lands and actually splits in half. So actually slowing the neutrons down actually works when the concentration of uranium is that low. What you do is you run a technology called a fast neutron reactor, and you don't slow them down. You say, well, then the reaction won't start. You start with 20% concentrated uranium, so there's enough for the reaction to take place. And once it gets going, those fast neutrons will convert the uranium-238 through a two-step process into plutonium, which is fissile. And so back in the 70s, when we were talking about this technology, we called them breeder reactors because you're making more fuel than you're using. And then you say, well, what about all the fuel we have? Well, you can recycle that to extinction. In fact, France had the only commercial fast nuclear reactor in the world. It's called the superhelix. Now it's closed now because it's old, but they took their waste from the conventional reactors and ran it to extinction in the superhelix. And so there are these technologies that deal with all three of those shortcomings, but we haven't been through the learning curve and we have to get them permitted. And there has been a big change over the Nuclear Regulatory Commission. And that started under Biden, but really was accelerated under Trump. And when you think about innovation in our history, and I've talked to people who have studied this, you cannot overestimate the importance of two entities in the United States: the Department of Defense and Bell Labs. Now, Bell Labs doesn't exist anymore, but we have Microsoft, Amazon, and Google. They have not a legal monopoly, they have an effective monopoly, and they just throw off free cash flow. And they care about technology as their lifeblood, just like Bell Labs. And you combine that with now the Department of Defense, because Trump signed these executive orders saying the Department of Defense is going to have X number of units running by such and such a date. Those are the first things that happen in nuclear that are actually specific objectives. And as we all know, you need specific objectives to get things done, right? I'm going to put a man on the moon, return him safely to Earth before the end of the decade. Is there anything about that you don't understand? Okay, it's pretty clear, right? It's one sentence, and that's what you're going to do. So you're going to have X number of military grade nuclear reactors that are small at your bases operating by these dates. Get it done. Figure it out. I know it's going to cost money, but that's your objective. So with the Department of Defense behind it and big tech behind it, that's why I think this is the best chance you're going to have. But keep in mind, from an investor standpoint, that venture capital investing. If you don't know the technology and you don't know the regulatory approval process, much less know which technology, whoever the customer is going to be, is it going to be a utility? Is it going to be big tech? Is it going to be the government? And the attributes that they're most looking for, then if you make money, it's because of luck, not skill. So this really belongs not in the realm of publicly traded companies, of which we have some, but it belongs in the world of venture capital, where you have highly skilled people that, and again, they get things wrong too. As we know, venture capital is like a small percentage of very large wins that have generated the excess returns. I don't know why this would be different. And so I have investors saying, I know this is long-term, but I just have a very long-term view. And it's like, if it's publicly traded and it goes down 80%, you're going to sell it. No, I won't. Yeah, you will. Okay, you will. So, and then it's going to go up 50% or whatever if it's successful, and you're going to miss it. And so I tell folks, you really need to stay away from this. You can tell I know something about this. I'm not a nuclear physicist, but I know something about the regulatory and the investment, and I don't have any money, either personally or any of the funds because I know I'm not a venture capitalist, and I don't have time to learn, and the payout isn't worth my time. So I ask people to just kind of stay on the sidelines.
We went down this direction a little bit earlier, but maybe focused more from an investing perspective now. The differences and opportunities for investors between, like you said, regulated, vertically integrated, cost plus markets and the competitive markets.
Yeah, so the independent power producers have sold off recently because people are saying, where are you going to get your earnings growth? As it turns out, most of their earnings growth is going to come from their nuclear power plants, which they already own. So while building new nuclear power plants may not be competitive yet, existing nuclear power plants are highly competitive. So the wholesale price of electricity today is, call it, 6 cents a kilowatt hour. The variable operating cost of an existing nuclear power plant is like 3.5, 4.5 cents. It's highly competitive. But a new one, the last new one we built, needs 20 to 25 cents. It was completed a year and a half ago. It needs 20 to 25 cents to pay off its investment. And it was built by a vertically integrated utility. And by the way, there's not a single nuclear power plant in this country that wasn't built by a cost plus utility before deregulation. And so those stocks are suffering, even though they kind of have locked in earnings growth for a significant portion of their business just from their nuclear power plants. Because in the recent legislation, the Build Back Better, there is, and in the well, that was the BBB, right? Under the green energy thing, there were subsidies in there that would really represent a floor price for nuclear to make sure that the price would always support at least the variable cost economics of the existing, and that grows with inflation. And so when you look at the earnings of those companies, they're kind of mechanically gonna grow. But depending on where those stocks are trading, they either embed a lot of risk in a cyclical commodity business, or they don't. And in the vertically integrated ones, the risk is not that the demand isn't there. It is. It's not that they're going to recover their costs. They will. But if the companies, and they're not going to build nuclear power plants, but they will build natural gas, and they have experience doing that. But, there is always regulatory risk. The good thing is it's state by state. It's not really at the federal government. And so when you look at our portfolio, we have almost no utility positions greater than 2 or 3%. Now, that wasn't true 10 years ago when we had just a handful of power utilities who had gone through the deregulatory process. They had gotten rid of their energy trading desks. They had gotten rid of their merchant power. And they were in places that were growing much faster than the average growth in the utility sector. Today, there's a homogeneity in the expected returns of so many of these companies that your expected return is roughly the same. Yes, there's some exceptions to that. But why take event risk of having all your eggs in 2 or 3 states? Because you say, well, okay, because the Pennsylvania governor is rattling a saber about it. Now it's a deregulated state, so you're only talking about the poles and wires there. But then you have the wildfire risk, out west, or you have some other risk that's political or whatever. That's event risk. It's not tied to the economy. It's diversifying risk from a portfolio perspective. But as an investment manager, why would I take on any event risk that unnecessarily when I can spread my basket across a large number of the 50 states? Now, the other thing we haven't talked about is natural gas. So if we're going to build all this natural gas fire generation, we need new natural gas pipelines. And that's a cost plus business too. And even if it's not strictly regulated on a cost plus basis at the federal level, which some pipelines are and some aren't, it depends on whether the market area they're in is deemed competitive by the Federal Energy Regulatory Commission or not. So that cost plus system has softened depending on where you are. And again, this is what's confusing for investors if they're not experts. But instead of having a cost plus model, what the natural gas pipeline companies insist on is a 20-year take or pay contract before they put a shovel in the ground. And now during the shale boom, everybody was climbing all over themselves to build new pipelines to the shale and everything, and the returns went down. They were still decent returns, but the returns are much higher today because the shareholders are demanding capital discipline that they were not demanding 10, 15 years ago during the shale boom. So there's opportunity there as well as there is in liquefied natural gas exports. So there is this knock-on effect to natural gas. So when you look at the pipeline part of our portfolio, it's heavily weighted towards that. And you haven't asked me about Iran, but as a lead into that, I will tell you that some of our portfolio companies export not just natural gas, but natural gas liquids. And again, this is one of those ways that industries confuse people. Natural gas liquids would include propane and butane. All right. So natural gas is methane. The molecule is very simple. It's 1 carbon and 4 hydrogens. Okay, that's what comes through your stove. Ethane is 2 carbons. Propane is 3 carbons. Butane is 4 carbons. They all come out of the ground at the same time. To separate them from the methane, which is going to your house and is lighter than air, the others are heavier, so they create a safety risk. They freeze the whole thing, and the bigger molecules fall out as liquids, hence the name natural gas liquids. But at standard temperature and pressure, okay, it's a gas. So that propane tank next to your gas grill, slosh it around. It's a liquid because it's under 80 pounds of pressure, bicycle tire type of pressure. And so at that pressure, propane is a liquid. But as you know, you open that nozzle, it's a gas. And so we export natural gas liquids primarily for people to use for petrochemical feedstocks. And those countries that are so dependent on natural gas liquids coming out of the Strait of Hormuz have been making quite a few phone calls in the last 3 months to providers in the US to expand that capacity under a long-term contract so they have another source of petrochemical feedstock besides the Strait of Hormuz.
I think we could keep it to two final questions, probably about 10 or so more total minutes. And I'll lean into where you started in your last answer with natural gas. That was coming up. Since natural gas will play a larger role, as you described it, in adding power generation capacity, from an investing perspective, what are the opportunities? And aren't some of these companies still formed as MLPs?
Yeah, some of them are. So I prefer infrastructure. I mean, our whole strategy is essentially, the fee-based, tollways, of the energy system. What I find interesting, people say, well, I don't want to invest in your fund. I'm not investing in energy. I was like, good, because either am I. To equate us as an energy investment would be the same as equating a private equity investment in a highway to an investment in General Motors or Ford. And you say, well, the two have nothing to do with each other. Exactly. And my pipeline has nothing to do with Exxon. Of course it does. Of course, the highway without GM and Ford has no cars and doesn't collect tolls. Without Exxon and Chevron, my pipeline has no natural gas and I don't collect tolls. But the point is the revenue model is entirely different. And so we stick with that. And whether the company is formed as a C corporation or a publicly traded partnership, we are largely indifferent to. As you know, there was a big boom in MLPs, and people equated MLPs with energy infrastructure. But a publicly traded partnership is how the company is financing itself. And it's operating under a safe harbor because there's only 3 businesses that are allowed to list as publicly traded partnerships. All the others have to be C corporations, and it's passive income like a mutual fund. It is natural resources, and it's real estate. And the reason those were carved out was because they have alternatives, right? Because drilling funds were all partnerships. Real estate can be a REIT, and a mutual fund can be an M corporation, which doesn't pay tax. So those were the 3 carve-outs, and it doesn't tell you what assets that financing vehicle is financing. It doesn't tell you if the revenue model is cyclical and competitive or whether it's non-competitive and cost plus or semi-competitive on a 20-year contract. And that's how investors got fouled up. The people that ran MLP funds told them that they were non-cyclical energy infrastructure. But I have a graph on our marketing deck that graphs out the earnings of the MLP index, and it overlays perfectly the earnings of the S&P Energy Index. Less volatile because half of the cash flows in the MLP space are stable, but the other half were just as cyclical. So it's the same pattern with just sort of half the beta. And so this is why MLP investors got burned. They were using the corporate structure as a proxy for what the assets were. And if I said it once, I've said it 100 times. If you don't know the difference between an asset and liability side of a balance sheet, I would suggest you not be managing someone else's life savings. I know that's snarky, but you know what? Either those fund managers, either they didn't know what they owned or they weren't being straight with their investors. Only one of those two can be true. And so that's why, you saw those funds have such terrible performance because the underlying earnings went down. And so when you look at the big correction in oil prices that happened in 2015 and 16, the composite earnings for the S&P energy sector, Exxon, Chevron, the producers, the refiners, the oil drilling companies went down 83%. The earnings in the Alerian MLP index went down 31%. The earnings in our portfolio went up 1% over the exact same time. And so there is a difference in which MLP you owned and which energy infrastructure. You know, the infrastructure is a loose term too. It doesn't tell you whether the revenue model is stable cost plus. People, you know, there's these infrastructure funds out there now that are investing in data centers. You know, that's not a cost plus monopoly business. So, that's sort of how we, look at it. We're somewhat indifferent to the corporate structure, but not indifferent at all to the quality of management, the quality of the assets, and whether the revenue model is cost plus and non-competitive, or whether it's cyclical and highly competitive.
And Jim, as you also hinted, I think we'll wrap up with effectively the U.S., Iran, Strait of Hormuz. I may have a little follow-up question depending on your overall context for my audience, but why don't I throw that at you and we'll take it from there.
So for our perspective, there is a sympathetic correlation of the stock prices in the pipelines to the S&P energy sector. So if I graph out the earnings, you would see that one grows and the other is sort of horizontal and cyclical. But in a short period of time, the correlation can be high. And that relates to sentiment for the world of hydrocarbons. And so with respect to that, you say, well, okay, oil's, $90 a barrel plus or minus, depending on what phase of this negotiation we're with Iran. But I think it's becoming clear to people that the genie of Iran discovering that they can control this strait with drones, and the military not quite yet having the countermeasures for those, it is tough to put that genie back in the bottle. And it is therefore tough to imagine that the risk premium on crude oil, even if this war ends tomorrow, that risk premium goes to zero.
Yeah.
It's possible. I just don't think it's likely. And then the other thing that affects us is, from a security of supply standpoint and a pricing standpoint, what sets the price of petrochemicals in the world, of course, is the high cost producer. The high cost producers use byproducts from a refinery as feedstock.
Yeah.
Those byproducts have an alternative use in transportation fuel. They are therefore structurally more expensive than the natural gas liquids, whose alternative use is simply making heat. In the world of energy, there are effectively two markets: transportation and heat. Heat has competition. Transportation does not. Okay, it's diesel, jet fuel, and gasoline. And yeah, you can talk about electric vehicles all you want, but you're talking decades before you turn over the internal combustion engine fleet. So therefore, the people that handle and store and process and export natural gas liquids in the United States as an alternative feedstock to petrochemicals have always had a cost advantage. That cost advantage has doubled in the last 3 months. And that's why those phone calls are coming in to those companies today from Japan and Korea and Taiwan and India and other places. They want security of supply, and they want to have access to feedstocks whose alternative is a much lower value than transportation fuel. And so those are the two things that sort of affect our portfolio. It is very hard to connect any dots at all to what's going on in the Middle East to our regulated investments in utilities in the United States. It's almost impossible to connect those dots. They have nothing to do with each other.
And of course, given you made that comment, this question, final one, may not be as applicable, but I think the audience may find it a little intriguing if you have an opinion on it. I'm going to throw out the names that are maybe in play here: China, India, Japan, Europe, US consumer, LNG buyers, insurers, refiners, or central banks. The question: if the Strait of Hormuz were closed or severely restricted for a long time, 90 days, 180 days, who gets hurt first?
It'll be Asia. That's where most of those exports go, because the U.S. is sort of energy independent from a physical standpoint. But here's the real answer to your question is that most of the discussion outside the energy industry, because when we talk amongst ourselves, we're like, does anyone realize how close we are to a disaster? I'm not sure they do, because they think that the two belligerents here can simply come to an agreement very quickly if they're so inclined, right? And you say, well, okay, maybe they can, maybe they can't. But so therefore, all the discussion is about the price effect. But the price effect is a symptom. Okay, so let's just think about this from an economic standpoint. So it's 20% of the world's crude oil is stuck behind the Strait of Hormuz. 20 million barrels a day out of 100. 5 is getting out through the pipeline in Saudi Arabia to the Red Sea, and so far the Houthis haven't bombed those ships yet. And about 1.5 goes through outside the strait on the UAE. And so you say it's 15, okay? But let's keep the math simple. Let's say it's 20% of oil. Oil is 35% of the world's primary energy. You say, what's primary energy? Coal, natural gas, nuclear, oil, wind, solar, geothermal, and hydro. It is how energy starts off. You are mining energy. You then convert it to electricity, you convert it into motion, or you convert it into heat, but primary energy is where you start, and oil is 35%. So 20% of 35% is 7%. And you say, oh, okay, so that would be a 7% decline in the world's economy, if only. So when you look at the relationship between GDP growth and primary energy consumption, it's a 2-to-1 relationship. So when we look at global GDP for the last 5, 10, 15 years, it grows at about 3% real per year, and primary energy demand growth is 1.5. So if it works the same going the other way, that 7% decline in primary energy would imply a 14% decline in the world's economy. I know that sounds alarmist, but that is the arithmetic. And you say, but it wouldn't be that bad. It would be extremely mean and unfair, but the people that use that electricity for basic needs like heating and cooking, they're going to get screwed, but the manufacturing world will outbid them for the molecules.
Yeah,
no question. That's why it wouldn't be 14%. But the world economy doesn't create demand for energy. Energy enables the world economy. It is very hard for people to understand this because they see how much in our society services are part of the economy. Those services don't exist without somebody somewhere converting a natural resource into a useful product. That's what humans do. Lawyers and accountants are simply enabling that process. Leisure spending is from the profits of that process. So like when Texas says, oh, only 30% of our economy is oil and gas, we have accounting, we have these great universities, we have law, we have engineering, it's like we have the cement business, and it's like, what are they pouring the cement for? What are they making the steel for? To make pipes? I mean, it's a fiction to think that most of that activity isn't ultimately related to extracting hydrocarbons out of the earth, which are needed to run the economy. And so it's, a modern economy is human beings exploiting external energy that's not human beings or animals, eating food and pushing a machine. They're machines that run on this stuff. And that's why we have a modern world. And that's why GDP per capita exploded over the last 200 years, et cetera. Take away that energy, you take away GDP. And it's literally the inverse cause and effect that most people think it is. And so that's the real risk here. And the longer we go, the slower it will be to get that production back online. And when you look at what's happening to inventories today in Asia, they are approaching basically levels that they have never been before in absolute terms, much less when you divide that inventory by sales, sort of the days of sales coverage that your inventory represents. So that is the sort of Damocles hanging over the White House right now. You can, the U.S. inventories are fine because we're a net exporter of energy, but we're still paying global prices. And then you say, well, okay, so Asia gets screwed and we're okay. Well, I'm not sure. I think the world is a little more integrated than that in terms of its economy. And so ultimately everybody will pay the price. Will the AI data centers be affected by that? No way. Right. So yes, the earnings in the S&P 500 are up. We have this industrialization going on that's AI related. All of that is good. But there's a lot of other stuff that, is in the stock market that could have a sales problem here 6 months from now if the world economy doesn't have enough primary energy to run on. So this thing is getting long in the tooth.
Jim, I don't know what to say other than incredible. I appreciate your time for over an hour. I think this was incredibly deep and insightful. Audience, mainly more so my investors and family offices, I would think. I hope you found this valuable, but even if not, hopefully incredibly educational and of value to you, understanding to some degree, as per Jim's last comment, how interconnected, even when you don't think so, a lot of this actually is. So everyone, I hope you had a chance to enjoy it. I look forward. I haven't done as many interviews. We have some more coming up, including one other this week. We had a great one last week with Alex Finn. So a combination of my solos, my longer form, and even today wasn't quite so short form like I kind of hinted at in the beginning. I just kept the questions a little bit more limited. But I hope you respect the opportunity of deeper dives into macroeconomics, geopolitics, investing in AI, and ironically, today's discussion really touched all four of the core topics that within the family office community that hopefully I have an edge and have a focus on and look to bring you incredible resources, including outside, of course, of myself with people like Jim. I will state, because there was some investment element to our conversation, and I'm sure that Jim would agree, that at the end of the day, you all have a different scenario, a risk tolerance, a liquidity need, a time horizon. And if you are investing, do understand conditions can change rapidly, practically day to day. And when you invest, you could lose money. So at the end of the day, you need to do your own diligence, your own research, think for yourself, make your own decisions. And again, repeated one more time, when you invest, you could lose money. Jim Murchie, that's Murchie, again, co-founder, co-portfolio manager, and CEO of Energy Income Partners. Jim, for those that have an interest in following you and learning more, and maybe, again, they need to be an accredited investor or qualified purchaser, how could they learn more about your organization?
So two things. You can follow me on LinkedIn, and we put stuff out there from time to time, but only when there's something interesting and we're getting a lot of inbound questions. And usually that's a short version of what's on our website, which is eipinvestments.com, which is easy to get to. So if all you have is my name, you'll get 6 pages of stuff on Google. So I've done a number of these podcasts, I'm in the investment business. So, my name is everywhere. So we're easy to find if you just know our name. But the eipinvestments.com, there's an insight section there. So all the data I was quoting about the electricity market, those are all in white papers you'll see. And there's other podcasts I've done that are there. Or just look at either EIP or myself on LinkedIn and you'll find us.
Well, thank you, Jim. It's been too long. We look forward to having you on more frequently, obviously, with all that's going on in the world today, including some of the core themes that I mentioned that I focus on. You're a guest that really touches all of them. Everyone, I hope you enjoyed it. Follow me on @FamilyOffice across multiple platforms, including, of course, YouTube. And I'm simply my name on LinkedIn. Like Jim noted, that's also where I have a lot of interaction. And those that want to take it further, that are ultra high net worth investors that are forming a family office or have a family office. I've been in this community for decades, would like to hope I'm an original thinker and spend a lot of time and focus on some of the areas that I mentioned, AI, macroeconomics, investing in geopolitics, and I believe have both a different spin, have incredible members around the world making a peer-to-peer community. So not just intellectual rigor and private content for my members, but the opportunity of face-to-face interaction from Vienna to Mexico City to Palm Beach, LA, New York, Greenwich, Miami, other locations where I happen to host events. Go to angelorobles.com and simply learn more, including about membership and being an active part of a community where this summer, no rest for the weary, we're extremely active. On that note, if you're live, you'll see me a couple of times this week. Have a lot of things to do, a lot of things to talk about. Again, we'd like to thank Jim Murchie, who was a great guest. Jim, such a pleasure. Look forward to the next time.
Yeah, let's not make it 7 years next time. Great.
I know. Maybe we'll cut that by a quarter, about a year and a half.
Oh,
Okay. Thank you so much.
Thanks
Bye-bye.
for having me on.
My pleasure. Bye.